Let's get started. Once again, good afternoon, everyone. My name is Vikai. Thank you for taking your precious time off in joining me in this webinar for a 6-step process to DIY your own financial plan. First of all, I would like to say that I'm sharing this information from a practitioner standpoint, rather than representing any particular company from my own experience and opinions. This will be the agenda for today. It should take about 45 minutes to an hour. But before that, a little bit of background about myself. I graduated from NUS with a Bachelor of Engineering, and I spent the first 5 years of my career as a project manager. I started the financial services career in 2011. I'm a chartered financial consultant. I help busy professionals in their journey to financial clarity. Outside of work, I am passionate about running and soccer. I'm 40 this year. I have 4 kids. They are 5, 7, and 9 years old this year. Yes, if you're wondering, we did have an elder daughter born in 2010. Unfortunately, when she was born, she had a genetic disorder. She was diagnosed with a genetic disorder, and she spent the first 2 months in the ICU. So the disorder was such that her body could not break down proteins in milk, and the byproducts were toxic to the central nervous system. In that year, we frequent the hospital and chalk up huge medical expenses of around 50,000. Unfortunately, at the end of the year, she left us at 10 months old. And because of that, because of the personal experience, that gave me a strong conviction to make sure that I want my friends and clients not to go through the same emotional and financial stress that we did. My guiding principle in my work is very simple. That is to partner my clients in their journey to financial clarity, because I feel that the financial planning process is a long journey, and it's more important for me to create trust and build long-term relationship more than anything else. From my last 10 years of my client meeting experience, I think these are the two major problems that consumers face: frustration and confusion. Frustration may be because of the lack of advice or the lack of service, and confusion because of increasingly newer and better products that are introduced into the market. And that's compounded by confusing government schemes like the MediShield Life, MediShield, ElderShield, CareShield Life, and CPF matters. So I hope that in this session you'll get some clarity about what you have, and also the steps for you to enable you to build your own financial plan. So the flow of the presentation will be like this. So in order to know how to build your own financial plan, I think it's important to understand the basic concepts of what's financial plan, what are insurance, what are the financial instruments. Then it'll be easier for us to talk about the consideration and the steps to DIY your own financial plan. And thereafter, I will leave you with some considerations for a holistic financial plan. So what is a financial plan? It's a comprehensive overview of your financial situation, of your goals, and the steps needed to achieve them. And that could include cash flow, savings, debts, insurance, investments, net worth, retirement planning, estate planning, etc. And of course, financial planning is the ongoing process of reviewing your situation and developing strategies to achieve them. If I were to put it in a very layman picture, I think that would be, this pyramid should sum up what financial planning is about. First, I think we need to lay the foundation of a financial plan, which is to have the adequate protection in case anything unforeseen happened. And after the foundation of your financial plan is being laid, then we go to accumulation of wealth accumulation in the short, medium, and longer term. And of course, in the end, when we leave, then we talk about how to distribute the assets that you have built over your entire lifetime. I think to me, this will sum up what financial planning is about. I'd like to run through some common myths that I come across when I speak to clients, and probably just 3 of them, and some misconception that people have about insurance and financial planning. Myth number 1, financial planning is buying insurance policies. And of course, I think that is wrong, because insurance is only part of a financial plan. There are other areas of a financial plan that includes cash flow, like what I mentioned before, asset and liability net worth, retirement planning, and estate planning. Myth number 2, I have multiple insurance policies from different or even the same company. I cannot claim from all of them at the same time. This is also another common question, common misunderstanding I come across. And yes, as long as policies are enforced, you can in fact claim from all of them, and as long as the condition is a covered benefit. For example, death, total permanent disability, and critical illness, with the exception of the reimbursement of medical expenses, because we can only claim up to the amount that we incurred for medical expenses. And the third myth I would like to go through is sometimes the clients tell me that they have hospitalization cover. I do not need a critical illness plan. And I think, of course, this is not this hospitalization and critical illness cover is really 2 different type of benefit. Hospitalization covers you for your medical expenses incurred in a hospital when you require treatment, and critical illness cover pays you a lump sum in the event that you are being diagnosed with one of the 37 conditions defined by the Life Insurance Association of Singapore. And these are also these just some of the common insurance myths that they're consolidated during a recent seminar, and you could have a look if you are keen to have the slides later on. So at this point, just like to let you consider a quote: buy when you don't need it, because when you need it, when you may not be able to buy. So what are the types of different benefits that you can be covered for under the different types of insurance plans? These are I think these are almost all the different types of benefit that you should be considering if you are talking about insurance and protection planning. Some of the more straightforward terms I will not go through, but I would like to go through some of the benefits that might cause a bit of confusion. Total permanent disability, when we get covered for that, okay, if we consider 2 eyes, 2 arms, and 2 legs, if we lose any of 2 out of the 6 items, a person is considered totally permanently disabled. But however, if there's a disability which make the person totally incapable of doing any work, performing any work, then this is considered as a TPD claim also. For advanced CI, if you have policies that you probably bought around 2010 and before that, most likely you have a critical illness cover that is only covering advanced stage. Okay, we talk about a very commonly claimed critical illness like cancer. An advanced stage cancer claim will be when there's a malignant tumor and it's spreading. Okay, and I think this is probably around stage 3 and above. Therefore, if you have only advanced CI cover, then for the earlier stages, you may need to consider early CI cover, which is more common in recent years because of this loophole that was presented from the critical illness cover last time. So for early CI cover, you can get covered as long as there's a malignant tumor that's being discovered, and even though it has not spread yet. So for the different types of benefits, you can actually get it in different types of insurance plans. That means the different types of insurance plans can give you the same benefit. So it really depends on what is your what are the different plans that you are looking for. And generally speaking, generally speaking, the types of insurance plans are being categorized as term plan, par plan, participating plan, and investment-linked policy (ILP). Term plan will be anything that has no cash value, like term life, critical illness, or it can be a mortgage insurance. Participating plan, par plan, and ILP will have cash value, but they have different type of underlying investments. And par plan will be plans that you hold, like a whole life plan, endowment, retirement plan. And investment linked plan will be quite straightforward. That means you're investing into managed funds. I think it'll be easier if we put two type of different products together to compare. But bear in mind that it's really not an apple-to-apple comparison, because, for example, like term plan is term plan you have low premium, and of course there's no cash value. So you can imagine like you're renting a flat. You're renting a flat, and it lasts you for fixed term. For whole life plan, you'll pay higher premium to own the property, and the plan can cover you for whole life, like what the name suggests. Par plan and ILP will have cash value. However, how the premiums are being invested are different. For par plan, the premiums are put into an insurance fund, which we call par fund. And generally, because of the objectives of the par fund, the insurance company can actually have some guaranteed benefits and non-guaranteed benefits based on the investment returns. However, if you do take note that if you need to take a loan, let's say if you will not be advisable to take a loan from your own par plan, because you will be charged at a high interest rate of 6 to 7%. If you were to take a policy loan against your own insurance policy, par plan policy. Investment-linked policy allows you to invest via managed funds, and because it's investment, the returns are non-guaranteed. However, they do provide flexibility like premium holiday and partial withdrawal. So this could be quite useful when you need to make certain changes. So investment-linked policy generally will have more leeway for you to play around. For the investment that I mentioned for par fund, you can easily do a quick search. These are the 3 screenshots that I took from Prudential, Income, and AIA. So in the par fund, you will see some history of investment returns and what are some of the investment top holdings that the insurance fund is holding, and the returns for the past few years. So you can do a quick search on whichever company that you have policies with. So just now I mentioned about the foundation, right? The foundation of the financial plan. Then let's talk about the middle layer, where you save and accumulate for short, medium, or longer term. So there are definitely different types of instruments that are available in the market. You can either do it yourself, and of course most people will have cash and fixed deposits, and you might want to go into Singapore savings bond, which is issued by the government, or you can also buy some equities and shares on your own, or you can buy structured products in the bank. And lastly, you can also do some unit trust investment on your own, other than the investment-linked policy for insurance. So these are the different types of instruments that you can actually use to save and accumulate your wealth over time. However, generally speaking, low risk comes with low returns, and higher risk comes with high return. So if we were to put it in a curve, right, of course, cash deposits and cash and fixed deposit will be the lowest end of the spectrum, and bonds, fixed income products will be generally less risky versus equities and shares and equities. And also, if you do come across something that is some products that give you very high returns that is too good to be true, then I think it is really too good to be true. It could be a scam. So do your due diligence when you come across such product. If you decide to invest in something that that gives you promise very high return, make sure you do your proper check. And you can also check under the MAS website to see whether they are on any investor watch list or not. So financial planning is very simple yet difficult. See, from what I went through just now, I think the instruments that we use for financial planning is not it's not rocket. Financial planning is not rocket science. The instruments are quite straightforward, but yet I think it's difficult because we don't wake up every day to think about, oh, let's do financial planning in the morning when you wake up. So likewise, I think so. In that aspect, I think it's important for us to have a system in place that can run at the background while we focus on the things that we like to do, the things we have passion for. And of course, I think we are getting busier and busier with work every day. So I don't think everybody will wake up in the morning to think that, oh, let's do some financial planning, let's buy some insurance plan, let's do some investment. So it's important to have some system in place. However, if you have done nothing at all, you have not done any consideration for insurance at all, you'll be glad that there are actually some common safety net that's in place for all Singaporeans and PR. The ones that are in place for us are Dependent Protection Scheme, DPS, MediShield Life, and ElderShield or CareShield Life. So if you were to do some upgrade, you can upgrade MediShield Life using via the integrated shield plan, or you can supplement your ElderShield or CareShield Life with additional payout. I'll go through briefly on this. The Dependent Protection Scheme is a term policy that covers a CPF member until the age of 60. So the total premium, if we average out over the years, right, it will be around $9 to $10 per month, and it covers you for a sum of 46,000. So, however, this scheme is an opt-out scheme. I think from my viewpoint, I think it's a very good plan. It's a very cost-effective plan. So please do not opt out of this Dependent Protection Scheme. From 2015 onwards, MediShield Life became compulsory. It offers protection for all citizens and PRs that is pegged at treatments being rendered at the public hospital B2 wards and below. The current limit is 100,000. However, starting 1st March next month, the annual limit will be raised to 150,000 per year. So, if for people who want more comprehensive medical coverage, then you can consider upgrading to an integrated shield plan. So look at the insurance company below. If you have one of the plans below, then you're likely to have an integrated shield plan. And why is it called integrated? Because of the additional cover that you would like to have, which is either like to get treatment in a single bed in a public hospital or private hospital wards. And why it's called integrated shield plan? Because having the integrated shield plan from one of the insurer, they will integrate your MediShield Life with it, such that you only deal with the insurance company and not CPF. Over here, I like to show two case study of an actual claims. Over the years, I've done quite a lot of claims, and I'd like to stress the importance of having a comprehensive medical coverage. This is a client's mom. She bought a private hospital plan from Aviva, my Shield Plan 1, with a full rider. So recently she went for a cataract op on both eyes. So the total bills came out to be 20 over 1,000. Typically, if you have surgery in a private hospital, easily I think the bill will be around 20 to 30,000. What if the bill size became more? So if let's say 20, 30,000, you could fork out with your MediSave or savings. What about this bill, this largest claim that I came across? So this is the largest claim that I've handled so far. The client is very young. He suffered a viral heart attack, and in the end, so it happens that he was in the ICU. He was on life support for the first month in the private hospital. and subsequently he remained in the ICU for almost for almost the next 2 months. So this is the part of the bill whereby is this 800 over 1,000 was being billed to him at the private hospital, because we are mindful about the limit of the plan. The limit of the plan was is 1 million. So we make a decision to transfer him to the family decided to transfer him to the National Heart Center, whereby it's considered public but a single ward. And eventually the total bill, the total claims came out to be around close to $1 million, 900 over 1,000. So like what the doctor said, if a person, if the patient does not have insurance, most of the time, sadly, most of the time the family might already have given up because of the size of the bill. So I cannot stress the importance of having a comprehensive hospitalization cover. So the last one that I want to go through with you is the long-term care, which is covered by ElderShield and more recently CareShield Life. ElderShield and CareShield Life covers us for the inability to perform 3 out of 6 activities of daily living. So you can see there is these 6 activities are transferring, toileting, moving around, dressing, bathing, and eating. So ElderShield, the previous scheme provides a smaller payout of 400 per month, and it's only up to 6 years. And you can have supplement scheme to increase the payout. And recently, last October, CareShield Life came into force. If you are born in 1980 or younger, you will be on CareShield Life. So CareShield Life was enhanced to give us a $600 a month payout for lifetime instead of 6 years. And likewise, you can also supplement the payout 600 with additional payout from a supplement plan from an insurance company. So this is one that is from Aviva, my long-term care plus. So okay, so if the common safety net is a bit confusing, let me just summarize it in this table. So for the dependent protection scheme, is a term plan that covers until age 60. It's a very good plan, covers you for 46,000 and covers us for death and TBD. For hospitalization and surgery, every Singaporean and PR will have MediShield Life, and I think it'll be good to upgrade to an integrated shield plan to a more comprehensive medical coverage. For long-term care, if you are born in 1979 and before, you'll be on ElderShield. If you are born in 1980 and younger, you'll be on CareShield Life. So let's go into the main topic today, which is the six-step process to DIY your own financial plan. Okay, I'll call it the 6 unique steps, not because it's unique, but in terms of financial planning, it's unique because we want to be consistent, we want to be systematic. So that's why for me, my 6-step process to DIY a financial plan will go like this: big picture clarity, which is to make sure that you're clear about your goals. Portfolio clarity, it is to understand what you have currently, to consolidate everything that you have and put together so that you know what you have. And once that happens, once you have more clarity about your goals and what you have, and it's easier to see whether there's any gap in terms of your financial plan, or in terms of the foundation of your financial plan. So once the foundation is laid, then we should consider the short, medium, and long-term wealth accumulation and the future lifestyle that you want. So I call it the lifestyle clarity. And then at the end, when we have to go, I think to a legacy clarity is to look at what you have, look at the assets that you have built up over time, and to distribute them more efficiently. The last step will be a review, because these 6 steps has to be ongoing. because financial planning is an ongoing process, and your personal situation will change year on year from time to time. So it's important to have a review about your financial plan. So the big picture clarity, just remember this 3333, these 4 digits. In the next 3 years, what are your 3 biggest dangers that need to be eliminated? What are the 3 biggest opportunities that you need to capture? And what are the 3 most important strengths that you already have that you can use to immediately transform your biggest dangers and opportunities? So when I do a big picture clarity with clients, I like to discuss more about both. I like to discuss both personal and professional goals, because I feel that it's important. Of course, we want to move ahead financially. We want to move forward financially, but it's important for us to be. We want to be happy with our progress, and sometimes goals might not be just linked to financials alone. So when you think about your 3 biggest danger, what are the 3 possibility of loss that there's the most dangerous that you need to avoid, and you need to eliminate. So when you're clear about the obstacle that you have, then I think that will give us a bit of motivation on how to come up with a solution to eliminate your danger. And for the opportunities will be an area whereby it gives us excitement. It could be something like, or maybe because you have a good cash position, how do you make the most out of it? Or any, let's say, opportunity in your work, what are the steps that you need to move up to your next level? So it can be personal, it can be professional. And at this stage I like to discuss both personal and professional goals with our clients. And by asking yourself these 3 questions, you should be immediately become clearer about your own situation. And I think you are the person that knows best. So there's a worksheet that I use. It's called the clarity worksheet. So you can, when you think about the 3 questions, list down all the dangers that you think that need to be eliminated, maybe like poor health, not saving enough, etc. Then the list down all the opportunities that you want to capture, and the strengths that you can reinforce and maximize. However, not to confuse yourself, not to confuse yourself too much. I think it's always important to prioritize the 3 items in 3 key areas. Then by having this clarity worksheet, you will be more clear about what you want to tackle in terms of the different areas, and that should give you more confidence moving forward. Once we discuss about so the next step is once we know your immediate goals for the next 3 years, and I think it's important to also come back to analyze your current situation. So in the portfolio clarity, the second step, I do actually have 4 sub steps, which is a portfolio summary, coverage summary, financial health check, and financial ratios. The 4 of them serve different purposes. So okay, so if you can recall, we talk about the different types of plans that you might have bought over time. So this is a table which I've been using for a long time, and it can capture most of the details that a person's insurance plan or investment plan will have. So on the left column, you'll see the benefits, the type of benefits that you're covered for. And each column will represent every single policies. So what a lot of clients like about this is because at a glance you can have a very clear detail about what you have what you've bought over all these years, and also it can also sum up the total premiums that you're paying. Because a lot of time when I meet clients, they tell me, oh, I don't really know what I'm buying. I don't know what benefits I'm being covered for. So if you recall, we try to go through some of the different types of benefits covered by different types of policies, right? If you were to go back and consolidate all your plans, put it together, search for the key benefits that's being covered, you can plug it into this table, and then you will have a very good overview of your current portfolio. And with that, if you are not too keen about looking at the numbers, you can at a glance you can actually have a graphical representation, which is what you are in total what you are being covered for now in the different areas, which is a death, TBD, critical illness, disability, accident, and hospitalization. These are the key benefits that I've covered just now. Do take note that some policies that you have may expire or mature. Like let's say term plan might expire, or endowment plan might mature. So your coverage might be reduced after a certain age. So do take that into consideration when you're planning, when you're constructing your own financial plan. Step 3 of portfolio clarity will be a financial health check. This will be one of the most important steps that you should be sitting down to figure out, because in a financial health check, it really just like if you treat yourself as a company, so we want to know how financially healthy you are as a company. So that will include your assets and liabilities, and with the assets and liabilities, you will come out with your net worth. And on the right column, we also want to do a cash flow analysis, whereby how much are you getting every month, and how much you're spending. Are you a spender or are you a saver? So look at the two equation below. Savings equals to income minus expenses, and expenses equals to income minus savings. These two are actually, in terms of equation, they are the same. But if you belong to the first row, if you're a spender, that means you will spend first and save whatever that's left. And that might not be too ideal. So it's better to think about it from the other way around. Be a saver. So every month, set aside a certain amount of savings, then you spend the rest. So think about it. It looks the same, but the impact is different. So with the financial health check, if you are able to come up with this table, come up with this analysis, then you will be able to analyze the important ratios for yourself. And these are the 3 important ratios that of course, there are a lot of other personal finance ratio, but in my job, I don't want to get clients too confused. So I just want to focus on these 3 ratios: the liquidity ratio, the savings ratio, and the net worth. So liquidity ratio, the last time the guideline, I think it used to be 3 to 6 months of expenses. But I think with with last year, what happened to the global economy for the pandemic, if you're not in the right industry, and if you have a problem, if you have problem like getting problem with the job on an extended basis, right, then having a lower, you might want to have a higher liquidity ratio, maybe up to 12 months or more than 12 months of your savings for emergency. And also, however, do take note that too much of liquid savings might be counter effective, because if everything is just in savings, and deposits, you will not expect that it will grow much in the longer term. Then the inflation risk comes in. Savings ratio generally, I think, saving as much as possible, but there's a rule of thumb that you can follow. I think that's quite a widely used ratio: 50 30 20, 50% into needs, 30% into your wants, and 20% set aside for savings. So if you are not sure about how you want to get started, think about this 532 ratio. And of course, net worth has to be positive, because if you liquidate everything that you have, if you are negative, then something is wrong. That means you're taking too much debts, or you're taking too much debts and not saving. So over time, we want to see our net worth improving, and with all these steps that you have put in, you should be able to track on a quarterly basis, yearly basis, on how you have been progressing over time. With the portfolio clarity, once that step is done, I think which is the most important step, then we'll be able to think about whether in your current financial plan is the foundation stable enough. So in the same different areas, you will have known your current, you will have known what you currently have, and versus what ideally what you need to have, or in your own unique situation, what do you think is the right amount to cover. So a lot of people ask, a lot of clients will ask, how much is enough, right? How much is enough for different areas? So I'd like to go through a few key, maybe a rule of thumb. For hospitalization, how much is enough? Are you okay with MediShield Life coverage, which is a public hospital B2 and below? Or do you want to have a single bed in a public hospital, or you want to get treatment at a private hospital? I think the consideration for hospitalization coverage is really the comfort while getting treatment, the speed while you're getting treated, the speed of getting treatment. Think about traveling. Do you when you travel, do you want to stay in a budget hotel or 5-star hotel? However, of course, if you are getting a more premium plan, then are you able to you have to think about the affordability of the future premiums. So look at the future premiums payable, and then think about how is it reasonable or not. So these are some of the considerations for hospitalization and surgical. For critical illness, how much is enough? Generally speaking, I think 5 times of your annual income or expenses is sufficient. So if you take 5 times of your annual expenses, you will get the lower figure. And if you take 5 times of your annual income, you will have the other end. And are you also focusing entirely on advanced stages? And with newer and better medical technology, I think I do see more and more early stages claim. So plan your critical illness coverage with a bit of layer. That means some early stages and some late stages. For death and TBD, you have to look at your current situation. Okay, if you are married, probably the annual expenses, you might want to consider your annual expenses times multiply by the number of years until your children are financially independent, and you should also include your liabilities. So imagine if you're not around anymore, then your spouse will not have to bear the burden entirely. So your expenses will be this amount will be paid out to clear your liabilities and to fund your family expenses until your children is financially independent. However, if you are single, I think there are also the consideration might be very different. You may or may not need so much of a death coverage. However, do think about whether are your parents dependent on you, and do you have any liabilities that you might want to clear away in the event that you're not around, because if, let's say, if the person that's paying for the for liabilities, I think usually the biggest liability for a person will be property. So if, let's say, the payer is not around anymore and is single, then if there's no insurance money to come in, then the property might have to let go at a cheap price. So having a mortgage insurance on your property might might ensure the best price, best purchase, best selling price for a property. So I think these are some of the considerations for married and single on death, TBD, or terminal illness. As a practitioner, I mean, from my point of view, we need to prioritize because we do have limited resources. And in my point of view, I think my priority when I plan for client will be such that I will make sure that they have a very comprehensive hospitalization cover, then followed by critical illness, then death and TBD, whether they are single or married, whether they they have any dependent. Accident and disability will be the next, but may good to have, but can be optional. So after the foundation of the financial plan is laid out, we will want to discuss about medium or longer term savings and investments. So these are some of the priority that you can think about. Your situation might be different, so you have to think from your own point of view. So once we have laid the foundation of your financial plan, then we want to go into the short term, medium term, and long term wealth accumulation and working towards your future lifestyle, future retirement lifestyle. So in a way, I think there's a lot of different commitments, and there's a lot of maybe you have some savings here and there. You have also a lot of people will have CPF, some may have rental income, and you have insurance plan that you need to pay. Sometimes some are limited payments, some you have to pay for entire lifetime. So when it comes all together, it doesn't become a very it's not simple cash flow. That's why for my planning for clients, right, I think it's good to have a more manual type of projection. So why I say projection is because let's say for this example, you start at age 49. So you start at this starting point, and when you're clear about your own financial plan, you can start to plug in the insurance that you have, plug in the expenses that you have, and the inflow, the income and expenses, and the whichever different category that you have. And it's important that for this lifestyle clarity, what we want to do is to also put reasonable economic assumptions like inflation, like your income increment over the next 5 to 10 years, etc. And what is the expected investment return if you're doing any investments. So when we do this on a more manual basis, we are able to project at a more accurately. And like for this example, this client came to me at 49. I was doing this cash flow for him, so we listed down all the future payments and the expected income and when he wanted to start to retire and when he can get out the CPF monies. So when all these things comes together, what we want to take note is the savings level. The last row at the bottom, the orange row, the savings level. So it's important that once we stop working, once there's no more income, right, the savings, our savings that we have accumulated can last us throughout until the day we pass on, right? So look at the orange row. So for this client, based on the analysis, he's probably okay. He's probably okay until maybe around age 75, which when the savings 73, 75. Around 74, 75, when the savings level gets really low, that's when the income stop coming in and the expenses are higher. So with a reasonable projection, then we can go back to the current time, like the present time, to say that, okay, what can we do to improve what we can project behind. So that's the purpose of this lifestyle clarity exercise. Okay, so when we have all these numbers, it'll be easier to plot into a chart. So look at the savings level. Although the client will hit a reasonable amount of savings at the age of 60, but because once he start to stop work, then and the expenses start to kick in, So you see that at the point, this of course is another example. At the point of around 70 years old, you see we don't want the savings level to go down. So when we have a trend like this, then we want to go back to the current age, to the present situation. What can we do to make better use, make better use of our current asset allocation to make sure that we improve the situation later on. So the fifth step of doing your DIY your own financial plan is to think about how you want to distribute the assets when the day comes when you're no longer around. So these are the five different areas which you should consider. And in terms of the easiest to implement, I've actually listed down. The number one will be CPF nomination. It's very easy to do CPF nomination now. You can even do it online. But if you don't want to do it online, you can go down. You can submit a form, or you can go down to the center. So the nomination, CPF nomination, do take note, it doesn't fall under your will. So even you have a will, you have to make a CPF nomination. And with a CPF nomination, they allow you to distribute your asset they accumulate according to your wishes. So likewise for your insurance nomination, the nomination of beneficiaries, the in Singapore, there's a framework for nomination of beneficiary, and they make it very simple. That means as long as you have an insurance policy, life insurance policy, you are able to do a nomination, which at no cost. So because this is just a servicing form, so it's called a Form 4. So you can do a revocable nomination that can be revoked at a later point in time if you wish to change. So the CPF nomination and nomination of beneficiary for insurance plan make it very easy as the first two steps in your legacy planning. So after which, I think the next step will be looking at doing a will. A will will cost you around 300. For a simple will, probably around $300, or more complicated, maybe $500. However, of course, it will be depending on whether you have crossed different milestones. And take note that when the will doesn't cover your CPF, right? Just now I mentioned, and also and I think at important milestone you should revisit your will to see whether any changes need to be done. So I think the last two steps will be having a living will. The lasting power of alternate LPA for short is a living will. When a person has totally lost the mental capacity but still around. So with that, if someone have not done that right, there might be a problem in terms of your caregivers trying to give you, trying to take care of you and trying to handle your money affairs, your properties for you. So because if let's say when a person lose mental capacity, then there's nothing can be done if there's no LPA. So generally speaking, you can, so for will and LPA, you can go to a law firm, or you can actually you can find a will writer. They can also do the same for you. And the lasting power alternate, so the price might vary. So I do have a list of like for example for LPA, right? You can do it as cheap as around $100 by yourself. If you can just make an appointment with one of the doctor that can do that. And of course, if you go to a specialist, will writing specialist or lawyer, then they might discuss they might discuss the will and your LPA more comprehensively. Then and of course you will be probably paying a premium. So there are different ways to do it. And the last but not least, the advanced medical directive. This is just to say that if you are, if you are, if you are in if you are in a situation whereby you are just sustaining the life and there's no quality of life anymore, you actually give the permission for the doctor to stop the treatment. So of course that has to be done while you are alive, just like the LPA. So with a legacy clarity, you can have a better, you can have put in the planning in place to distribute your assets that will build over time according to your wishes efficiently. Because if you have not done so, then it will go to the intestate succession act, whereby it will, for example, in different situation, right? Let's say if you're married with children, 100% will go to your own family. If you're married without children, then 50% will go to your parents and 50% go to your wife. So if you do have your own wish to distribute your assets in terms of estate planning, then I think it's important to think about all this legacy clarity, your own legacy clarity. And the last step, the last but not least, is a clarity review, because your personal situation changes. Remember this 1 to 100% rule. 1 year from now, 100% of your personal and financial situation will be different. So it's important to relook at the 6 steps and to go through them, make minor changes, and it's important to review over time. However, of course, I think if you have a very holistic and sound financial plan in place, you might not need to change much in the next 2 to 3 years, but it's still good to have a review on a year-to-year basis to see whether there's any changes or not, because the numbers will definitely be different. So with that, I hopefully I sum up what I wanted to go through, which is the diagram which I showed very earlier on. So for a holistic financial plan, I think we have to lay the foundation, which in terms of protection and insurance planning. Then after that, we accumulate your savings and via savings and investments for the medium to longer term, and then eventually we distribute the assets that you build over time efficiently. So the last part of this presentation, I want to give you a few key considerations for holistic financial plan. If let's say you're trying to DIY your own financial plan, what are the key considerations you should be thinking about? So I have 5 here. So number 1, emergency fund. Always have emergency fund is actually is the measure of the liquidity ratio. So always have at least 3 to 6 months. In my opinion, I think having a 6 to 12 months of emergency fund liquidity ratio would be more ideal. And I think the amount that you have as emergency in the bank, you can just ask yourself a very simple question: how much do you need to see in your bank for you to sleep soundly at night? Okay, and then that could be the number for your emergency fund. The number 2, the second consideration is the foundation of your financial plan. Remember, we talked about protection as the first layer. Make sure that, but however, everyone's situation is different. Okay, if let's say my situation, from the way I think, will be different from the way you think. So from a practitioner standpoint, so this is what I usually discuss with client. Okay, I'll give my opinion, then I'll find out the situation about the client, what he thinks, what he feels about his own objectives regarding the protection, amount of protection that they have. Then we come to a consensus about, okay, how much is enough. And how much is enough, of course, also depends on your budget. How much do you want to set aside for your financial plan, to put all this financial plan in place? And budgeting, when you're doing budgeting and the laying the foundation of financial plan, I think it's important to have a combination of the different types of insurance policy, so that and also have a different combination of wealth accumulation policies, your investment, your financial instruments, right? So that they are more adaptable to changes. For example, like something that was unforeseen last year, like the pandemic. So some people might have to might need to stop or terminate certain insurance program and suffer a loss. So the budgeting and the laying the foundation, I think it goes hand in hand. And having enough emergency fund will allow you to make more sound decision, and not to make a desperate decision to like cancel any plan or cancel any investments that is making a loss during bad times. So number 4, of course, goals. What are the goals you want to achieve? most of the time it'll be for shorter term goals. It'll be more likely to be property, like maybe big purchases like cars, and a medium term will likely to be like for married couples will be more likely to be children education, and children education can also be a long term goal. And of course the long term goal, for long term goal, retirement planning will also come into play. So these are the things that you want to consider. What are the goals that you want to achieve, and are your plans able to help you in getting the goals that you want? And number 5, I've stressed just now to have a regular review, because 1 year from now, 100% of your personal situation will be different. The numbers will be different. So it's important to do a regular review about your own financial situation. So if there's I'm nearing the end of my presentation. If there's 3 points to 3 key takeaways, you'll be that I think financial planning is a long journey. Your circumstances changes. Review your plan regularly. Also, if you have not done anything, or if you have done something, okay, you can tell yourself that doing something is better than not doing anything at all. But of course, most importantly, if you don't know what you have bought last time, go back and take a look at what you have bought, consolidate them into the portfolio summary, and then to understand what you buy, so that when you know what you have, it's easier to make progress. And for the priority for your for insurance plan, I think for priority for your financial plan, I think this will be the priority that I recommend. It means to have a comprehensive hospitalization cover, comprehensive critical illness cover, and then death or TBD depending on your own situation. And accident and disability will be good to have, optional, and good to have if you have extra budget. And after the foundation is being laid out, take a look at your medium to longer term savings or investments. Okay, so before we go into the Q&A section, there's a lot of information in the slides, and there are also quite a lot of links that I've included in the slides. If you are keen to have a copy of the slides, do drop an email. I'll send it over. I'm happy to send it over. And I also include a review checklist that you can take a look about the different areas that you can consider for your financial plan. And of course, whether is there anything I can help. If let's say there's something that you think that you need advice, do drop me a note. And so at this point, thank you for your time for sitting through until now, and I will start to welcome questions. For the Q&A. Yeah, so before the questions, before I wait for the questions to come in, maybe I'd like to start off with one of the common questions that client always ask me. I'm covered by my company. I'm covered by my company insurance. Do I still need a financial plan? So remember we talk about the insurance and insurance planning is actually just part of the entire financial plan, because your own financial plan covers the cash flow, covers other areas like cash flow, net asset and liabilities, retirement planning, estate planning. So of course, if you have your own company insurance, I think that is good. That will be good, because you can, when you DIY your financial plan, you can include your company coverage in it. Do bear in mind that your company coverage most likely will cover you only when you are still working for them. So if in future you're not working for them, you will lose this coverage. So do you want to include this in your own personal financial plan or not? So that's the question that you have to ask yourself. Okay, and I think another question that I another question that very, very commonly that I come across, you see, clients will tell me that I'm not sure what I have over all these years. See, I don't know what I bought. I don't know how much I'm paying. Where do I get started? Yeah. So I think for the start, right? Okay, if you still have hard copies of your insurance policies, do consolidate them. Like bring out everything, all the statements, separate them into the different plans that you have, and take a look at the different types of benefit that each and every one of them is giving you. So that's for a start. And if you cannot find all your documents, I think at this age, in these times, it's very simple now. Okay, if you remember which company you're paying, which company is you're paying premiums to, just go online. So almost every insurance company have their own portal now. So you just need to register as a client, and then you do a login. They will do some verification. You can actually go online and access your own policies. So with that, when you have your own policies, then look at the different type of benefits that you are paying for the policies and how much you're paying. So with all this information, you should be able to compile into that list, into that table that I showed under the portfolio clarity just now. Okay. Okay. We do have a question here. Okay. How frequently do we need to amend our financial plan? Okay, I think this question is very subjective, because if your own situation and there's no significant milestone, right? Assuming that you have done a very holistic financial plan, you have planned it well already, I think the plans will be good to last you for the next 3 to 5 years. However, there can be something happening. So what is the trigger? What is the trigger for you to think about looking at a financial plan? Maybe it could be a new milestone, a promotion, or getting married, buying a big purchase. I think these are the different milestones that you should think about looking at your financial plan to review. So there's really no hard and fast rule about how frequently should you be looking at your financial plan. It could be as frequent as twice a year, or it can be as long as 3 to 5 years every time. But I think it's important to put in place financial plan that is running at the background, so that you can focus on your work, you can focus on what you like to do best. Yeah. Okay. So I think I'm mindful about the timing, and thank you for staying with me until now. So if you, like what I mentioned, if you have any questions, do feel free to drop me a message. And if you're interested in the slides, I'm happy to send over. Just drop me an email also. With that, thank you for sitting through with me. Okay, and have a good day ahead. Thank you.